If you're interested in investing, you've probably heard that you need to buy your stocks at a discount to fair value. But how in the world do you figure out what is a discount to fair value when you're buying a stock? In this video, we are going to break down step by step how to evaluate a stock, and we're going to use Apple as our example.
This is by far the most frequently asked question from our friends and family. So we're going to go through a really detailed approach and go step by step in calculating the fair value of Apple. By the end of this video, you're going to know what we think is a fair value to pay for Apple today.
So let's dig in and get started. Hi everyone, I'm Sam, this is Chris. Thanks for tuning into our channel where we explore achieving wealth and financial freedom through a three-part strategy. Earn more, spend less, and invest the rest. Now, when we are looking for investments, there are four key questions that we must answer. Number one, do we understand the investment?
Does the investment have a strong, durable competitive advantage?
Does the investment have a manager or a leader who is honest and capable?
And can we buy the investment at a discount to fair value?
In this video, we are going to go through the valuation process by answering those four key questions.
And as a bonus, we're going to give you a fifth question that you should ask yourselves before investing in a publicly traded company like Apple.
So if you want to follow along with us as we do this tutorial, you're going to need something to write with, something to write on, an Excel spreadsheet that you have open on your computer, and you're going to want to open up your internet browser and make sure you have tabs open for Yahoo Finance, SEC Edgar,
Seeking Alpha, and Dataroma.
And Dataroma. So get those things ready. We're going to dive in and do a lot of work in this video and take it step by step. So let's get going. Question one, do we understand Apple?
Well, we understand that Apple is a consumer electronics company founded by Steve Jobs, Steve Wozniak, and that other guy.
Actually, his name is Ronald Wayne, and he sold his 10% stake back to Jobs and Woz for $800. That 10% share is now worth more than $200 billion.
Back to the topic at hand, they sell products that we all know, most of us have owned, such as the MacBook, the iPhone, the iPad, Apple Watch. They now have a streaming network called Apple TV with some shows that some of you have probably watched. They commit a lot of budget to research and development, which is great in a technology company that has to stay innovative. And, you know, even though I would say we probably don't understand everything about the technology and how that they create and that they sell, we probably understand pretty well how they make money. So yeah, if I was being asked, do I understand Apple as an investment? I would say yes, I do.
On to the next question. Do they have a strong, durable, competitive advantage?
We just did a video where we talked about the 5 competitive advantages that we look for. And if you ask me, I believe Apple has at least 3 of these. So they definitely have a branding moat. I think we all recognize Apple, or most of us recognize Apple products as a very high quality, very trendy product that most of us would like to own. We also, I think everybody can picture the Apple logo with just basically an apple with a small bite taken out of it. It's a fairly iconic logo, and I think, you know, some of us probably, even those not born yet in 1984, remember that iconic commercial with the woman running and throwing the sledgehammer through the pane of glass. So it's stuck with us over time. So they've definitely built a brand recognition competitive advantage. And those competitive advantages are very hard to break through. It takes a lot of time for a competitor to come in and really replace that kind of imagery with their own.
And what about competitive advantages 2 and 3?
They probably have one of the strongest switching competitive advantages of any company in the world. So Apple has done an excellent job of creating this ecosystem of devices. Right? So you don't just buy a MacBook. You're going to buy a MacBook, you're going to buy an iPhone and an iPad and an Apple Watch, and they're all going to synchronize together, and they're all going to use the same accessories like power cables and things like that are unique to Apple. You can't use them with other devices. And in that way, when one of those devices go down, you're not going to replace it with an Android because it will be too painful for you to do this. It will cause you distress. So you're going to go out and you'll replace it with another Apple product, and you're just going to continue doing that.
And the third competitive advantage that they would have would be secrets because of their intellectual property and the patents that they own on the technology that they develop.
That is a competitive advantage. It's probably not one of their stronger ones, but it is one that as investors we should be aware about.
Okay, so far we've got 2 checks. We understand the business, and not only do we have one durable competitive advantage, but in this case we actually have 3. So step 1 check, step 2 check. Now we move on to our third question. Does Apple have a leadership team consisting of honest and capable people?
Well, as far as capability, we usually look at a couple key indicators. Return on equity, you're going to look at return on invested capital, and you're going to look at how well they pay down debt, or how well they minimize the amount of debt that they have to take on so that they can grow their business. And I'll be honest, Apple's probably one of the best companies in the world that does this. I mean, their return on equity, their return on invested capital over the last 10, 20 years is been phenomenal, and they have very low debt. When you're looking at honesty in a management team, what you want to do is you want to look at the articles that are written about them. You want to look at the interviews they've done. You want to look at the shareholder letters that Tim Cook, the CEO of Apple, has written to the investors of Apple.
Shareholder letters can be found on the company's investor website.
And you just want to kind of look for whether they are meeting the goals, that the targets they are setting. So, we generally go back 10 years and start reading those shareholders to letters, and those letters to shareholders, and we just kind of see, okay, they set this kind of target for 5 years. Well, then we can fast forward to 5 years and see if they've actually hit those targets. We also want to see a management team that takes responsibility for the mistakes that the company makes and gives credit to their employees for the successes that the company has. Those are good signs of a very good management team. And if you want to look at a management team that is exceptional at this, look at Berkshire Hathaway. Warren Buffett's letters are a perfect example of how a CEO should write a letter to shareholders.
Okay, so we understand Apple, we know that it has a durable competitive advantage, and we trust that the management team are in fact good leaders. So now it's on to question number 4. Is it priced at a discount to fair value?
All right, to answer this question, we're going to use a method called the margin of safety calculation, which is a method we first read about in Phil Town's book, Rule 1.
It's a really great resource to build your investing foundation when you're first getting started. So if you're interested, we will put a link below where you can get a copy. So what is the margin of safety method?
It's a method of determining what price you're willing to pay for a stock based on an educated prediction of what its future value will be.
The process involves forecasting the company's earnings out for 10 years.
Then we're going to multiply those by an appropriate PE ratio to get a 10-year price target for the company.
So that gives us an idea of what a fair price would be for Apple 10 years from now, but we need to know what is a fair price today.
Yeah, so then we're going to have to discount that 10-year price target by a rate of return that we would be happy with achieving over the next 10 years.
And that's it, right?
Not quite. We always say we need to buy this investment at a discount to fair value. So we're going to have to apply some sort of markdown to the fair value price just to give us a little bit more margin of safety or confidence in that investment.
Okay, so now you know everything you need to know. Just kidding. Let's go through the example and we'll walk you through step by step using real world current data.
Okay. So the first thing we need to do is we need to go and pull some important financial information about Apple. So what I'm going to do is I'm going to open up a couple pages, and for me, the page I like to use is Seeking Alpha, though you can use quite a few different pages. You can use Yahoo Finance and others, but I do like Seeking Alpha. It gives me a lot of the information I'm looking for. So the first thing I need to do once I reach Seeking Alpha is I need to type in the Apple ticker symbol, which is AAPL. I know they don't know how to spell at Apple. I don't know what happened. Okay, so remember what we need is we need a earnings per share, an EPS. So this is just the total amount of earnings that Apple makes divided by the shares outstanding that the company has. So you can see that the forward EPS is $3.96, but this isn't the EPS I'm looking for. I'm looking for the trailing 12-month EPS. So this is the actual earnings per share that Apple achieved over the last 4 quarters. So I'm just going to go into the financials. I'm going to look at the income statement. Okay, so the income statement has been populated. So I'm going to go down, scroll down until I see the earnings per share basic. So here it is. I've got this entire row, the last 10 years of earnings per share for Apple. So what I'm going to do is I'm just going to copy those over and put them into an Excel spreadsheet. Okay, so I've now got my Excel spreadsheet. I've copied over the last 10 years of earnings, and now I'm going to start to analyze these numbers. So the first thing I generally do is I'm going to just put these into a chart, a scatter plot chart. Okay, so I'm going to insert scatter plot. Okay, and here it is. So I'm just going to expand it, make it a little bit easier for everyone to see. And what you're going to see is we've got the last 10 data points for earnings per share for Apple plotted in this scatter plot chart. So what I'm going to do is I want to actually look at these by applying a trend line. So I'm just going to right click on the points and add trend line. So what it does is it adds a linear trend line, but that's not quite what we're looking for. We're looking for an exponential trend line to actually get some compound growth rates established. So I'm going to just come over here and click exponential. And you can see it adds a little bit of curvature to the line. The other things I want to do is I want to just come down here. I want to forecast this out. Remember, we're looking for the earnings per share in 10 years. So a nice way to do this is actually just to come in here and forecast it out forward 10 years. And I also want to display the equation on the chart. So this is the equation for the trend line that we just drew. Okay, so that's been done. And now it's appearing on the chart. I'm going to come in here, I'm going to make the font a little bit larger so it's easier to read. And there we go. So now that we have our earnings per share for the last 10 years plotted, we've added a trend line and we've got the equation to the trend line here. What I'm looking for is I'm looking for the consistency in the earnings over the last 10 years. I'm trying to classify Apple whether it is a consistent company, a predictable company, or is it cyclical and it's a little bit more up and down. One of the reasons we chose Apple to value first is because it is an incredibly predictable company. And you can see that from the earnings per share against this trend line, how tightly they hug the trend line for the last 10 years. So this is great. So one of the things we always want to make sure of is the earnings per share trailing 12 months that we're using. Is it an outlier or is it a fairly standard earnings per share for the company? So obviously if we see that the last earnings per share is either unusually high or unusually low, then we need to understand why it is. We need to read some of the letters to shareholders. We need to look at the annual reports, and we need to figure out why is it an outlier from the norm. And if it is an outlier for some reason that is not going to be happening in the future, it's not reoccurring, then we need to remove it from our data. Okay?
So for example, a COVID outbreak.
Absolutely. If a company is adversely impacted by COVID, then you're going to see something, probably somewhere down here. So it's going to, negatively impact earnings per share, and those are going to be abnormally low. But for Apple, to be honest, Apple has done exceptionally well, even throughout COVID. So you can see that it's slightly below the trend line, but not by much. Now, one of the things I want to draw your attention to is actually the equation for this exponential trend line. What it is, the exponent is actually your compound growth rate. So you can see up here you've got 12.1204. That is your compounding growth rate over the last 10 years, 12.04%. So that's really useful. That's one of those pieces of information we needed, and this is one way to get it. I will say that this is a way that I don't see many people use. I see people use more of a compound annual growth rate formula, which I will also do just as a comparison. So I'm going to slide this over and I'm going to start putting some numbers in. So what I want to do is I want to start populating this compound annual growth formula, which I'm going to put all the formulas I use in the description so that you can copy and paste them into an Excel sheet yourself and start playing with them. Okay, so I'm just going to use the, put the years up here that I'm analyzing. I'm going to be using 2011 and the 2020 data point. So the earnings per share in 2011 was $1. So I'm just going to reference that cell. And the earnings per share in 2020 was $3.31. So that's the trailing 12-month earnings per share, $3.31. For years, just going to subtract these to get the time frame that we're looking at, which is 9 years, and it gives us a compound annual growth rate of 14.22%. So you can see there is some discrepancy between this number and the compound annual growth rate that we calculated on the chart. This is because the chart is actually using all of the data points, whereas the compound annual growth rate is only using the first and last data points in the 10-year period. So it starts to give us a little bit of a range on what kind of growth rates and what kind of earnings we're going to expect in 10 years. So that gives us two of our growth rates that we're looking for. I also want to jump over and just look at what the analysts are saying. So let me see here. So the first thing I'm going to do, I'm just going to add these growth rates down here. Just going to type in 12.04 from our chart. That gives us the first two growth rates. Let's look at the analyst predictions. So what I like to do is I just come over here. I'm going to go to Yahoo Finance. Yahoo Finance. Again, I'm going to type in the ticker symbol for Apple, AAPL. All right. And it's going to come up here and bring up the summary page. So what I want to do is I just want to go to analysis. So generally you can find analyst predictions over the next 5 years. So that's the common estimate that you're going to see is a 5-year estimate of earnings per share. So I'm just going to scroll down here. Growth estimates, looking at the next 5 years, 12.64%. So coming back here, looking at that growth rate in comparison to the two that we've already calculated, that actually looks pretty in line with what we're thinking. So yeah, that's excellent. So we've got three growth rates. 14.22, which is what we got on our compound annual growth rate formula. We got 12.04, that's what we calculated using the trend line for the last 10 years. And we've got 12.64%, which is what the analysts are telling us that their estimates for the next 5 years are. That's obviously not a 10-year estimate, but it gives us an idea of what the future holds for Apple. So, okay, so we have a growth rate. We have the trailing 12-month earnings per share. Now we need to actually forecast the 10-year earnings per share for Apple. So we're going to do this by using the future value formula in Excel. So I'm just going to type that in. So I just type in FV, brings up future value, and it starts to just kind of give you what you need, what kind of information you need to put in for this calculation. So we're going to calculate the 10-year expected EPS using the compound annual growth rate formula. So that is going to be the 14.2%. So that's our rate, comma, number of periods, we're looking for 10 years. So I'm just going to enter 10. There's no payment. This is actually a formula for interest payments. So there's no payment. We're going to skip that. So I'm just going to push another comma. And this is going to be the present value. So that's going to actually be the trailing 12-month EPS. Now, this is the way the formula is set up, this is how you calculate interest payments. So it's actually going to be a negative. So we're just going to put a negative in front of the trailing 12-month earnings per share. And we're going to close the formula by adding a parentheses. Okay, so that gives us $12.51 is what we're expecting the earnings per share to be in 10 years based on the growth rate that we calculated with by using the formula.
All right, guys, don't be too scared. I know that Chris is crunching through numbers like a maniac. Don't worry, I'm in the same boat as you. We can get through this, we can do it. Just pause the video and take it step by step.
Okay, so now we're going to repeat the process with the growth rate that we used by populating the chart, which was 12.04%. So we're going to do the exact same thing. Equal sign, future value, FV, rate, 12.04%, number of periods, 10, payment we don't have, and present value, again, negative, trailing 12-month EPS. And that's going to give us $10.32. So we've now have a range of expected earnings per share values in 10 years for Apple. And if you come over to the, well, first, before I do that, let me just find the average. Now I want to actually find an average of this so I can use that as what I'm going to carry forward on the 10 years earning per share. So I'm just going to say equal sign, average function, and it's just going to be these two values, the average of those two values that we calculated. I'm going to close parentheses, and I've got $11.42. Now the interesting thing about that is if you come over to our chart where we forecasted the next 10 years of earnings, it's actually sitting at about $11.42. So it worked out perfectly with what we were thinking. So now what do? We've got the earnings that we're expecting Apple to have in 10 years. We need to multiply it by a price to earnings ratio. So this is the amount of money that people are willing to spend for $1 of earnings, okay? And the way I'm going to calculate this is I'm going to go back to Seeking Alpha. I'm already in Apple. I'm going to go to Value. And I'm using Seeking Alpha, but you can go through a lot of different websites to find this information. Whichever ones you're comfortable with is fine. You just basically want to get a historic range for the PEs of Apple. So what I do is I just, Seeking Alpha has this function where it's really convenient. They will just show on a chart what the PEs have been, and I'm going to look at the 10-year chart. Which is right here. So what you can see and what maybe most of you are seeing in the markets is we are in a bit of definitely a tech bubble. And you can see that Apple has a PE ratio that really, I think it's 40 right now. It's a little bit over 40, 41.67. And you can tell that's not the historic average of Apple. So what I want to do is I want to go through and find a PE that I feel confident every few years at least Apple will be priced at that kind of price to earnings ratio. So what I'm looking at is I'm just looking at the 20 PE line. It bumps it here, it comes close, it bumps it here, it bumps it here, bumps it here, it bumps it here. I like 20. I can see by this, 20 gives me a lot of confidence to use that as a PE ratio. So I'm going to use 20. Another thing you can use, just say a little bit of a correlation. So the average PE ratio for the stock market over the last, 100 years has been 15, okay? And the average growth rate over the last 100 years for the same stock market is 7.5%. So it's a pretty good correlation to say that people are willing to pay 2 times earnings, 2 times growth rate as a PE. So that's that's something we can always use. So we're looking at using about a 12% growth rate. So we could expect our PE somewhere between 20 and 24. But I'm going to be a little bit more conservative. We're going to use 20 as the PE ratio. So I'm just going to insert 20 into here. Okay, so stock price is calculated as earnings per share times PE ratio. So that is the price that I think, that is a fair value for Apple in 10 years. That is what I think a target price for Apple will be in 10 years, $228.32. Okay, so the next thing we're going to do is, remember, that's the fair value in 10 years. We need to find out what the fair value is today. So I'm going to discount that value by a rate of return that I would find acceptable if I earned over the next 10 years. So to me, I always use 15%. And that might seem high to some people, it might seem low to others, but the reason I use 15% is because the historical return of the S&P 500 with dividends is somewhere around 9.8%. So I think I should earn a little bit more, because if I was targeting 10%, I would just invest in the entire market. I'm not. I'm looking for better returns. I'm investing in individual companies, and I'm expecting higher returns. So I'm expecting 15%. So now what I'm going to do is I'm going to do the opposite of what I've done before. I'm going to use the present value function instead of the future value function. So I'm just going to type that in. So that starts with PV, brings up present value function, present value formula. I'm going to enter the rate I'm expecting as a return, which is 15%. Number of periods, again, is 10. Payments, again, is 0. And the future value, again, it's a negative number, $228. What does that give us? $56.44. That is what I believe is the fair value of Apple stock right now. Now remember, we are value investors. We are going to try to buy things at a discount to fair value. So the amount of discount depends really on two things. It depends on the predictability of the company that we're investing in, and it depends on how experienced we are as investors. So the more experience we have and the more predictable the company we're investing in is, the smaller the discount that I would be looking to have. Taking all that into consideration, considering that Apple is an incredibly predictable company, and that, to be honest, I've been doing this for 10 years, I feel fairly experienced, I'm still going to use a 15% discount. Now, do not be afraid to use up to a 50% discount. And you can buy companies at 50% discount. The market can be that crazy sometimes that they will price things at a 50% discount. But Apple, because it's so consistent, because it's such a huge, well-known company with all these competitive advantages, it's very rare that you're going to get it at that kind of discount. So I would be happy to get it at a 15% discount. I feel like that would protect me from permanent long-term losses. So what I'm going to do is I'm just going to mark this down by 15%. So what I'm going to do, just 1 minus so I'm just going to put 15% in there as the discount I want. Okay, so I put 15% in as the discount, and now I need to get the price. So it's just going to be the fair value price times 1 minus the discount. So this is going to be 85% of the fair value price, which is $47.97. Okay, so I just want to look at what the current price of Apple is to know how much more expensive it is than what I'm willing to buy it at. And it's $137.13. So that's way more expensive than I'm looking to buy it at, $137.13. Okay, I'm also just going to go over back to Seeking Alpha, and I just want to look at what the trading range has been for the last 52 weeks. So you can see the 52-week low for Apple is $55.74, which is about 75 cents off of what we think the fair value is. So $55 and 77 cents? $55.74. So at one point this year, which would have been, I would imagine, April, this Apple stock was actually trading for below fair value. Not quite the 15% I'm looking for, but not far off it. So I can just tell you from what we were doing, we were actually sitting there selling put options to purchase Apple if it had gotten somewhere below $50. So we were still, making money from it, though it never did get to our strike price, and we never got put the shares. But we were, taking advantage of the low prices that we were being offered in Apple, but we weren't able to buy the stock. So you've got to remember that as value investors, we are trying to follow Warren Buffett's rules, which are rule 1, don't lose money. Rule 2, don't forget rule number 1. Charlie Munger, who's Warren Buffett's right-hand man and one of the best investors in the world, he says it best when he says, we don't make money buying and selling, we make money waiting. So that's what we're doing right now. We're waiting for Apple stock to be at a price that we're willing to buy it at. But we're also looking at other companies, because there are other companies right now that are currently at or below fair value and that we are currently investing in. So we're going to continue doing these valuations of different companies, and you can follow along and.
Okay, so that's how we calculate the fair value for a stock. But in the beginning of this video, Chris mentioned a 5th bonus question that he always asks when we are looking at investing in a publicly traded stock.
I did, yeah. So we're always going to check if there's any super investors that are also invested in this company. It just adds a little bit of validity to our investment thesis and gives us a little bit more confidence.
Mm-hmm. And how do you find out who's investing in what?
So the great thing for us retail investors, us little guys, is that the SEC, which is the Securities Exchange Commission, this is the government body that regulates investing, they require fund managers managing more than $100 million to submit a 13F filing quarterly. So this is basically just a report on what is in their portfolio at the end of every quarter. So this is public information. We can go online and find out exactly what they're investing in.
All right, walk us through that.
Okay, I'll do that. I'm going to go back to the internet now. Okay, so we're looking to see if any of our super investors are currently invested in Apple. How do we do that? Well, like I said, there are requirements for fund managers to disclose their holdings every quarter, and there's a lot of websites out there that will actually compile this information and make it really presentable. So Dataroma is the one that I like to use. It's a free site, so it's one I check into quite often. So we're just going to type in Dataroma. There it is. Invest alongside super investors. To point out, not every one of these investors on Dataroma is one that I would consider a super investor, but a lot of them are. I'm just going to come up here. I'm going to search Apple, which I've already done, and open it up. Yes, I'm going to clarify that it is in fact Apple Incorporated that I am looking at. Yes, there is an ad. Okay, so I'm at Apple's page. There's 11 super investors that are currently invested in Apple, and I'm going to scroll down to see who it is. And lo and behold, it is my favorite investor, Warren Buffett. 47.78% of his portfolio is currently in Apple stock. That's nearly 1 billion shares of Apple. Just to point out, when it says a percent of its portfolio, it doesn't include a cash position. So right now, I think Warren Buffett and Berkshire Hathaway is sitting on probably 140 or 150 billion dollars in cash. So that's a considerable percentage of his portfolio that is not being counted here. But still, 47.78% of his marketable equities is in Apple stock. That's huge. That's a lot of confidence in Apple as a company. Now, what I would tell you is he definitely did not invest in Apple at the current prices. I think he was investing somewhere, and this would have been before the stock split, somewhere south of $140. So divide that by 4 and you're going to get about $35 a share, and that was probably 4 or 5 years ago. So he's done quite well on Apple so far, and I would imagine if Apple got back down to somewhere in the 50s or 60s, he'd be investing again. So yep, that gives us a lot of confidence that yes, Apple is a great company, we're willing to buy it, but it needs to be at the right price. So again, we are waiting. Okay, so something that Sam and I like to do, we just like to validate the information. So Dataroma is a great site, it compiles all this information, but let's check for ourselves that this information is in fact accurate. So what I'm going to do is I'm just going to open up the SEC EDGAR website, which is a bit of a difficult website to navigate, and we're going to do our best. Okay, so I just type in SEC EDGAR into Google. Yep, it's the first link that it sends me. And now I'm going to search Berkshire Hathaway. Comes up. Okay, so it gives me a few options. Berkshire. So I'm just going to start clicking and hoping that I get it. So I think I clicked right. So Berkshire Hathaway has a few different entities for different things. So you need to work through them and find the right one. Berkshire Hathaway, Fire, Marine, and Casualty Insurance. I believe that's the entity that holds most of Berkshire's marketable equities. So I'm going to go to the information table, HTML, and I open it up. And this, yes, I have clicked on the right thing. This is Warren Buffett's holdings currently. So it's in alphabetical order. Great. Apple comes up fairly soon in the list. And we can see, yes, he definitely holds close to 1 billion shares. So this is his share count. Yeah, he holds quite a bit still. So yes, Apple is something that is currently in his portfolio. It's something that checks 4 of the 5 boxes that we're currently looking at, but that price is a little bit high right now. But we're keeping an eye on it, and we're going to keep rechecking these as we get more and more information. But yeah, we're waiting. So what you do is up to you, but yeah, Sam and I are waiting on Apple.
Alright guys, we hope that you found this video useful. We sure did enjoy making it for you. If you did, be sure to like this video, subscribe to our channel, and as always, we welcome your comments below. Remember, earn more, spend less, and invest the rest, and we'll see you next time.